In 2025, four technology companies made the biggest bet in corporate history, $381 billion. That number was public. Analysts saw it. The market barely blinked. But buried inside lease agreements, legal filings, and complex financial structures is another number, $120 billion. A number that doesn't appear where most investors expect to find it. It's not missing. It's not fraud. It's not a mistake. It's debt, hidden in plain sight. And according to regulators, central banks, and lawmakers, it may be one of the least understood risks in the entire AI boom. This is the autopsy. Before we talk about the risk, you need to understand the tool. It's called a special purpose vehicle, an SPV. The name sounds complicated. The concept is not. Imagine you want to build a house, but instead of taking out the mortgage yourself, you create a separate company. That company borrows the money. That company owns the house. The debt exists, but it sits inside the company, not directly under your name. Your personal balance sheet looks clean, but the debt is real. Now replace the house with a data center the size of a city block. Replace the homeowner with Microsoft. Replace a mortgage with tens of billions of dollars. That's the basic idea. Microsoft, Meta, Oracle, Amazon. Billions of dollars tied to AI infrastructure through leases, bonds, financing arrangements, and special purpose entities. The structures are legal. The auditors reviewed them. And that is exactly what makes this story interesting, not because anyone broke the rules, but because everyone followed them. The debt exists. It just doesn't sit where most people think it does. And when something is hard to see, it becomes very hard to measure. And when something is hard to measure, surprises become much more likely. If these structures are completely legal, why are some of the world's most powerful financial institutions paying very close attention? That's where things start to get uncomfortable. Over the past several years, multiple institutions raised public concerns about increasingly complex financing structures connected to large-scale infrastructure investment. The Federal Reserve, the Bank for International Settlements, members of the United States Senate, different organizations, different mandates, different countries. But many of their concerns point toward the same issue: visibility. When risk becomes difficult to see, it becomes difficult to measure. When leverage is difficult to measure, surprises become far more likely. These warnings were not leaked, they were not secret, they were published publicly, available to anyone willing to read them. And yet, most people never heard about them. At the exact same time these documents were being released, headlines were dominated by benchmark scores, chatbot features, and billion-dollar valuations. The story everyone watched was the race. The story almost nobody watched was how the race was being financed. If the warnings were public, why does nobody know about them? Understand the scale. Let's look at 3 real examples. Not because they're identical, but because together, they revealed a pattern. Case 1. Meta. Meta wanted to build some of the largest AI infrastructure projects in the world. The obvious option would have been straightforward borrowing. But there was another route. Financing structures connected to private credit and special purpose entities allowed enormous capital to flow into infrastructure without appearing the way most retail investors expect. The project gets built. The debt exists. The exposure becomes harder to visualize. Case 2. Oracle. Oracle approached the problem differently. The company raised billions through the bond market, but the money wasn't funding traditional expansion. Instead, it became part of a much larger ecosystem. Infrastructure providers, financing arrangements, AI-related obligations, not a single line of risk, a network. And networks are far harder to understand than balance sheets. Case 3. Microsoft. Microsoft's position may be the most fascinating. The company helped finance enormous AI infrastructure. At the exact same time, it invested heavily in building its own AI capabilities. Think about that for a moment. One of the companies helping build the entire system is also preparing for a future where the system could completely change. It's simultaneously placing the bet and hedging against it. That tells you something important. Even the people closest to the broom understand that uncertainty exists. Now leave the United States, travel thousands of miles across the Pacific, Australia, different regulators, different companies, different institutions. Yet the pattern begins to look familiar. Private credit markets expanded rapidly. Traditional banks stepped back from certain types of lending. Alternative lenders stepped in. Regulators began examining how risk was being reported. At the same time, Australia recorded a historic number of business insolvencies, particularly in industries heavily dependent on financing. Again, not fraud. The issue was visibility. How much risk exists? Where does it sit? Who ultimately holds it? And perhaps the most important question of all, if similar structures are appearing across multiple countries simultaneously, who created the blueprint? There are only 3 realistic outcomes. The first is success. AI adoption accelerates beyond expectations. Revenue explodes. Demand far exceeds forecasts. The infrastructure pays for itself. The debt becomes irrelevant. The people who understood this early win. The second is stagnation. Revenue grows, but slower than expected. Construction slows, expansion pauses, the technology works, the economics don't. Investors who assume the math worked out discover it didn't. The third outcome is contagion. A major financing structure fails. Losses spread through lenders, funds, insurers, and every institution connected to this system, not because the debt suddenly appeared, but because people finally realized it was there all along. Only one of these scenarios requires something to go wrong. The other 2 happen naturally. The problem is that nobody knows which future we are heading toward. Not regulators, not investors, not the companies making the bet. The debt exists. The structures are legal. The warnings were published. The question isn't whether this is happening. The question is what happens next. If this changed how you see the AI boom, subscribe right now, because the next video goes deeper into what regulators found after they started digging. And that story is even bigger than this one. Don't miss it.